This company is posting a massive 150% return on equity, but its top-line revenue is only growing at 5%. In financial markets, investors use ROE and EPS as the primary metrics to gauge corporate success. However, a 50% or 100% ROE does not necessarily indicate a healthy business. Companies can use aggressive share repurchases and heavy debt to drive these headline figures upward. This engineering can mask actual operational performance, even when it is deteriorating. To identify these patterns, we will deconstruct returns using DuPont analysis, compare the strategies of Apple and General Electric, and calculate true growth using a non-cash model. When returns aren't supported by operations, the growth is a result of accounting, not expansion. How do profitability, asset efficiency, and debt combine to produce the returns reported to shareholders? DuPont analysis separates return on equity into 3 interlocking gears to reveal the specific source of a company's returns. The first gear is profitability, measured by the net profit margin. This shows how much profit a company extracts from every dollar of its sales. The second gear is efficiency, or asset turnover. This measures how effectively the company uses its factories, inventory, and cash to generate that revenue. The third gear is financial leverage. This tracks how much debt the company uses relative to its equity. If a company's ROE rises while its profitability and efficiency gears remain stationary, the entire gain is driven by debt. Because of this, the operating income margin provides a clearer insight into a company's health than the headline ROE. When a company generates excess cash, management must decide how to return it to shareholders. Dividends provide predictable income, while buybacks offer corporate flexibility and different tax implications for investors. When a company executes a buyback, it purchases and retires its own stock. The total profit pool stays the same, but the number of outstanding shares decreases, making each remaining share represent a larger portion of the pool. Even if net income remains flat, reducing the share count mathematically forces earnings per share to increase. The same mechanic applies to ROE. Spending cash to buy back shares shrinks the company's shareholders' equity. As the denominator decreases, the final ROE percentage rises. This allows a management team to report double-digit return growth while the underlying business remains stagnant. In these cases, EPS growth represents a shift in capital structure rather than an improvement in business performance. The choice of funding determines whether a buyback strengthens a company or hollows it out. Since the year 2012, tech giant Apple has repurchased over $500 billion in stock. These buybacks were funded by massive cash reserves and strong operational cash flow, meaning the company did not need to borrow to support the program. In contrast, General Electric spent a staggering $24 billion on buybacks between 2015 and 2017. GE funded these repurchases using heavy debt, while simultaneously reducing investments in research and development. The combination of debt-funded repurchases and poor timing weakened their balance sheet, eventually forcing the company to sell core assets to survive. These failures share common traits: heavy debt-funded stock repurchases, reported ROE exceeding 70%, and erosion of the equity base, as seen in companies like Home Depot. Buybacks only create long-term value when funded by a true operational surplus, not borrowed money. If standard metrics are affected by share counts and debt, how can we calculate a company's actual expected growth? The traditional fundamental growth formula multiplies retention rate by ROE, but this fails for modern companies with large cash reserves. The calculation incorrectly assumes idle cash will earn the same high return as active business operations. Professor Aswath Damodaran's non-cash assets model isolates the operating business from these distortions. We first find the non-cash net income by taking total net income and subtracting the interest earned on cash balances. Then we calculate non-cash equity by subtracting the total cash balance from the total book equity. Dividing these yields the non-cash ROE, showing the return generated by the operating business alone. We then determine the reinvestment rate by dividing operational reinvestments, like capital expenditures and working capital, by that non-cash net income. Multiplying the reinvestment rate by the non-cash ROE provides a forecast of expected growth that is independent of financial engineering. Headline ROE and EPS figures can be misleading when viewed in isolation. Evaluating a company requires using DuPont analysis to isolate leverage, scrutinizing buyback funding, and stripping away cash balances to see the true operational engine.